Hi, everyone. Today is September 30th, 2021, and our subject of our free video conference today is, will there be a Santa rally? The good news is it was the deadline today for Congress to make sure that we could still continue to fund the government, and they did get legislation passed to do that. The bad news is we need a suspension of the debt ceiling as well, and that did not get passed. Now, technically, the deadline for that is October 18th of 2021. However, the closer we get to that date without suspending the debt ceiling, the more we risk our AAA credit rating with Fitch Ratings and Moody's. So that's something to keep an eye on. Another thing that really we need to keep an eye on is GDP growth. So it was expected to be 7% earlier this year. It was just revised down to 5.9% on the year. We had robust first and second quarters at the upper 6%, almost 7%. And the third quarter is actually expected to be under 4%. So how does this all play out? Is there going to be a Santa rally? We're going to talk about all this and more in just a moment. Okay, so today is all about, as you know, it's our free video conference, and it's all about, will there be a Santa rally? This affects stocks, but when stocks go down, it can also be detrimental to other assets in the marketplace, like real estate and that sort of thing. So it is important to know where stocks are headed. So let's talk briefly about some of the factors that can play into a Santa rally. The Santa rally is a pretty good, it has a good track record, but it's not flawless. So in December of 2018, we actually had the worst December since the Great Depression. So when it's bad, it can be bad, especially in today's world where the movements are very, very rapid, usually before Main Street can actually react to it. So the movements are largely generated by institutional investors. And by the time Main Street hears about it, you might be either late or they figured it out and the stocks are on the rise. So if you're one of the people who were just discovering that we were having a huge issue in March 23rd, 2020, the markets had already dropped 38% by that time. They dropped from February 19th to March 23rd, 2020. They dropped 38%. And then by the time a lot of people realized what was going on Main Street, the feds had already marched in, printed up trillions of dollars, and were handing it out. And so the institutional investors had greater faith that things were going to improve, and they started buying back, and we are now have stocks higher than ever, real estate higher than ever as well. There are reasons for that. And yes, this is supposed to be a very strong year in terms of GDP growth. So we have 5.9% expectations on the year, 6.7% in second quarter, 6.3% in first quarter. So if you can do your math and your averages, that means that the third and fourth quarter might actually be less than the first and second quarter. So this is important for you to realize, because in a typical year, most of the returns of the stock market are made in the Santa rally, because that's where there's a lot of economic activity. So a lot of people that are back to work, they're getting ready for holiday seasonal buying and that sort of thing. Since so much of our GDP growth in the US is consumer spending, a robust holiday season can equate to a robust, fourth quarter GDP. So that's something to keep in mind. But let's talk first about two things that were essential that would sink the Santa rally if they weren't resolved. One of them got resolved today, the other one is still not resolved. So the government is not going to shut down in the United States. Both sides, the Senate and the House of Representatives, came together, they passed legislation. They will fund the government only until December 3rd of this year. So only a few months, at which point they either have to agree on a full fiscal 2022 package so that they can put that to rest and go on to other stuff, or they have to punt the ball again and give it another couple of months. So we'll see how that plays out. But thank God we don't have a government shutdown, because that could have been a very big problem. The next big problem potentially is the debt ceiling. So what usually happens is it's suspended. So the last time we had this kind of crisis was in 2011 under another Democratic administration. It was the Obama administration. And the Republicans dug in their heels and said they would not help to raise the debt ceiling. And it got down to the exact day when we would have defaulted, which was August 2nd of 2011. And then they came together and they passed legislation. They suspended the debt ceiling, and there was not a default. However, on August 5th, we were downgraded by Standard & Poor's. Stocks went down, gold hit its all-time high, silver hit an all-time high. So those are things to be aware of, that if we do not agree on the debt ceiling getting raised, or preferably suspended than raised with a dollar amount, by X date. What is X date? October 18th. But if they get too close to X date, we still might be in trouble, because we have a AAA credit score from Fitch Ratings and Moody's. Both of them, before this crisis back in July, said, hey, with the US's robust GDP growth, we're not going to downgrade the US this year. The US is still on a negative outlook with Fitch. And so it was probable that we'd have to address something dramatically, have great, even better, more robust GDP growth, and really fiscal husbandry that was not only going to balance the budget, but also start reducing it in order to keep our AAA with Fitch going forward. But we were almost guaranteed we'd have it this year, unless we didn't suspend the debt ceiling in a timely manner. So every day that gets closer and closer to October 18th is a day that risks the AAA credit score of the US. Canada lost their credit score in 2019. They were downgraded to AA+. And that's what a lot of people are saying. Oh, well, everybody's in debt and the US is better than most of the rest of the world. And those things are true. There are certain countries that are growing much faster, like China and Peru, but 5.9% GDP growth is the best that the US has seen since 1984, in decades. Now, you're going to get all of this overview, by the way, in my blog. So remember that if you want to go back and look at the charts and look at the data and get the summation of what I'm talking about, just go to nataliepace.com/blog, and it will be the most recent blog that will be posted probably within the next 24 hours. All right, so here's what's at stake if we do not raise the debt ceiling in time. This is a Moody's Analytics. They did an 11-page PDF outlining what they thought was at stake if we do not raise the debt ceiling in time. So as you can see, we're going to have major job losses, unemployment rockets, stock markets definitely go down. They're predicting by at least a third, and 15 trillion in household wealth could be erased. Now, obviously, they have issued that report. Congressional officials have seen it. Janet Yellen has also said things very similar to that in her letters to congressional leaders in both the Senate and the House of Representatives. So they're aware of this. And, honestly, I'm not going to weigh in on either side of the aisle, because I'm more about pro-business and economics than politics. But what I will say is that both sides need to come together on this. And suspending the debt ceiling is not issuing new debt. It's like raising your own credit limit. And we have already made promises that we will not be able to pay if we do not raise our credit limit. We absolutely need to fix things going forward. It's understandable why we had the policies that we had during a pandemic, and it did prevent what could have been catastrophic economic, circumstances if they hadn't printed up all that. But that does leave us in a position where we have to figure out how we can start tightening the belt while keeping people employed, while keeping businesses strong and healthy and creating the products and services of tomorrow. All of these things are key. And that means that there is a little bit of truth on both sides of the aisle. We need to tighten our belts. We need an educated workforce that can create the products and services of tomorrow. So if you are into politics, what I would say is we need a bipartisan solution yesterday. We need, and it's usually a better idea to suspend the debt ceiling than put an exact number on it. That wouldn't have worked the last time, and we might not have been as successful in navigating, economically at least, the pandemic if we hadn't have had the ability to print up all that money and to help people, real, Main Street and Wall Street, to survive the pandemic. All right, so let's talk a little bit more about GDP growth. So I did mention already 6% is the best we've seen since 1984. Typically, good GDP growth means a good Santa rally, right? But again, the third quarter might actually look worse, and that comes in the advance estimate on October 28th. So it could come in as low as 3.2%, as high as 3.8%. Remember, we did have a Delta variant resurgence of the pandemic in the third quarter. So what is the first quarter? Well, January, February, March is first quarter, right? April, May, June is the second quarter. July, August, September. So we just had this today is the final day of the third quarter. And then we get the advance estimates on how well it was, how well it did on October 28th by the Bureau of Economic Analysis. So that's something to keep in mind, because while 4% GDP growth is not bad, it's not great, but it's not bad, it's much lower than the first and second quarters. And the reason why that is relevant and that might mitigate a Santa rally is because the valuations of stocks are so high. So we are expecting strong GDP growth, and if we don't get it, then we might get a rout. Now, I do want to mention, because obviously we did, this is the end of September, and I do want to mention a couple of quick things about the market. So clearly we did have a down day in the market today, and it was a down month. It was almost 5% down in September, but it's still up about 15%. So, we are already having a decent year. But here's what's a little bit more problematic, is what we would call price earnings ratio. So if we look at the Cape-Shiller index, you can see that the average price earnings ratio on Wall Street, the S&P 500, is 16 or 17. This is a 10-year average price earnings ratio that's put together by Nobel Prize winning economist Robert Shiller, and it's the blue line. So if you look at it, you can see that today at 38, it is higher than it was when we considered stocks to be very speculative back in 1929 before the Great Depression. Higher. So Great Depression stock speculation is now number 3. Dot-com speculation number 1, today number 2, Great Depression number 3. We probably will not have a Great Depression even if we have a market downturn, because of the ability to print up capital and keep people, flush with money. So that's the new policy. They weren't able to do that back in the Great Depression because the dollar was tied to the gold standard. So they had, parameters that prevented them from helping out all the banks. If those parameters were in place today, then we would be in real trouble. And in fact, we cannot keep printing money and borrowing from Peter to pay Paul. We're actually not borrowing from Peter. We're borrowing from our children and our grandchildren. So we actually really need for both sides of the aisle to come together and be honest with their constituents about where we are and how much debt we have. I want to show you, I don't want you to get too freaked out about it, but the amount that the US is in debt, and the rest of the world too, by the way, it's not just us. is very, very, very high. It's astronomically high. So I did a chart just so that you guys could kind of see it. And it is a problem. And right now, it's actually a bigger problem for bondholders than stockholders. And that's been clear for at least a couple of years. So this is, I went ahead and put in before the pandemic so that you could see that the problems were already brewing before the pandemic. And this is before June 2000 was at the beginning of the dot-com recession. June 2007 was right before the Great Recession started. So you can see this chart if you want. Just email us at info@nataliepace.com and say, hey, I'd really like to see that asset bubble chart. But clearly the debt is absolutely outstanding. If you total up all the total debt and loans, it's over $80 trillion. These numbers just get mind-boggling. So we really do need to start tightening our belts and fixing the debt. All right, so one other thing I wanted to talk about as well is that margin trading is hitting all-time highs again as well. What is margin trading? That means that people are borrowing money to buy stocks. Now, the problem with that is that if the stock market goes down and people have borrowed money to buy stocks, if it goes down enough, the brokerage wanting their money back has the ability to sell your stocks without your permission in order to cover your margin. So with the amount of people that are doing this, this could be an issue because it does send things, it speeds things up. Like, as I said, things move much faster in the markets today than they ever have. That 38% drop from February 19th to March 23rd of 2020, that was the fastest that a bull market had ever become a bear market. So you want to be ahead of it rather than reacting to it. So what do I think? I think that if we suspend or lift or raise the debt ceiling, within a week, then we're going to be in a lot better position than if we wait until the week of the 18th when we run out of money. So if that would be like, okay, let's have a pluses and minuses. That would be in the plus column for the Santa rally, right? If we wait until the week of the 18th, then it's going to be a minus. If we don't make the 18th deadline, it's going to be off the charts minus. It could be devastatingly bad. Could be good for gold, could be good for cryptocurrency, could be good for silver, because again, people losing faith in politicians and the dollar and worried about the economy and debt, they do look for safety. And younger generation is more interested in the new gold, which is crypto. So those are things to keep in mind. Okay, so once we get past the debt ceiling, we've got that October 28th date when the advanced report of GDP is issued. The markets tend to react to that as well. You don't get advance notice. You're going to have to, if you're on the West Coast, you're going to have to wake up at 5:30 to see it. If you're on the East Coast, it's at 8:30 Eastern. And if it's where it's predicted to be, which is under 4%, that could be negative for stocks too, because again, people have the prices of the stocks are too high. If it were still looking more like a 7% GDP, which was what we were going to have before we had the Delta variant rise up, and we had a really strong third quarter, then it's boding better for the Santa rally. So right now, what we have is a lot of ifs in the equation. So what is your best strategy on this? And again, remember, it wasn't that long ago. It was only December of 2018 that we had the worst December since the Great Depression. It was down over like a 12.5%, I believe, in this S&P 500. So your best strategy, it's not saying, oh, I think we're going to have a market meltdown and therefore I'm going to sell all my stocks. That is not actually a good strategy, because honestly, where you're going to go, you're going to buy bonds. Those are actually a lot more problematic. And if you don't know why, read I'll show you a couple of, remedies in just a moment. But definitely read the What's Safe section of the ABCs of Money. The 5th edition just came out. So the first reason that you don't just try to do market timing is that you want to be diversified. It's a very good idea to have, a home you live in that you own, but you must have purchased it for a good price and you have to afford it. So it's not just a matter of, I gotta buy a house, interest rates are low. That shouldn't be the criteria. If you need help, even if you're feeling equity rich, if you need help doing a real estate analysis on your home, we actually have a blog on that. It's free. So just email Heather and say, I want the equity rich blog, and she can send you that. So whatever it is that you want, you really want to think of it as a complete money plan, the Thrive budget, so that you're not making everybody else rich at your own expense. That's going to mean making brave choices and understanding this. Your problems are not avocado toast and cafe lattes. They're much bigger than that. And there are solutions. It's not like they're not solutions. So getting aware of the ways that you can actually stop making everybody else rich and start keeping that money for yourself and growing it, and money while you sleep and all of that is going to be key. The other thing is, because of the Federal Reserve and the Treasury now convinced about all of the different tools that they can use to keep the economy going, even when we have very little economic activity like we had in 2020, you can't predict when we're going to have a recession or for how long. Technically, to have a 2-month recession in the middle of a pandemic is really unheard of. And in fact, it surprised the Feds themselves. And they are absolutely very humble when they speak about it, and especially about what could happen in the future. I also want to say to you that while their dual mandate is to keep unemployment low and to keep inflation around 2%, they have clearly shown that they believe that keeping Wall Street healthy is a part of that. They actually purchased some exchange traded funds to help keep, they were bonds mostly, but they did purchase them, which I think is entering a gray area of what they should or shouldn't do, but because they're supposed to lend, not spend. But the bottom line here is that you can't control what the Federal Reserve and the Treasury do. So there is a very, very active saying on Wall Street right now, which is don't fight the Fed. Don't fight the Fed, don't fight the Treasury. So trying to jump out and jump in is fighting the Fed and the Treasury. And it's been very perilous to people's health especially since the Great Recession. So what is your best plan? Your best plan remains safe, protected, hot, diversified, and annual rebalancing at minimum, not more than 3 times a year, not less than 1 time a year. I also strongly recommend that you use the pie chart system, that you mock up that sample pie chart, you mock up a pie chart of what you do have, and then that takes the emotions out of it. It makes it very simple to see what you should be doing. If the slice is too large, you trim it back and you sell high. If the slice is too small, you beef it up and you're buying low. Also, if you're worried and you say, you know what, this is too much, there are too many ifs in that sentence, I'm worried. Rather than all in or all out, like you're always supposed to keep a percent equal to your age safe, right? So overweight safe, just pretend you're older. Like if you're 60 and you overweight 20% safe, you only have 20% in stocks. If it goes down by half, you only lose 10%. So that's how you can mitigate it a little bit. The brokerages would say, let's do a risk tolerance test. I think a much better gauge is, how do you feel about where the markets are? What level of risk do you think there is in the economy, rather than how do you feel about it? Do it data-based rather than emotional-based, because your emotions are usually on the wrong side of the trade. I'll give you a quick example, and then I'm going to stop the recording and we'll have a conversation if you have a few quick questions. It's a better idea if you have questions to email us beforehand so I can address them. So again, the email is info@nataliepace.com. Of course, you can always call us too at 310-430-2397. 310-430-2397. Okay, let me show you a couple of other things that can help you to do this, because as you know, we have free web apps where you can mock up your own pie charts. So just click on that and then you'll receive an email. If you don't receive it, check your spam, where you can download these free apps. And it's about 2 questions and 2 clicks, so that's less than 5 minutes. You can personalize your own nest egg pie chart and personalize your own Thrive budget. Also, it's going to make a lot more sense if you read the ABCs of Money. You want to make sure you're getting the updated edition, which just came out a week ago, the 5th edition. So go to nataliepace.com, click on the ABCs of Money book cover. Also, I just updated the 2nd edition of Put Your Money Where Your Heart Is. So go to nataliepace.com and click on that book cover as well. That is the original ESG investing guide. So if you're interested in environmental, social, and governance investing, this is the book that you should be reading. It was originally written in 2006. And again, it was updated and published a week ago. Also, you can attend our investor educational retreat where you can learn and implement these strategies. We spend 1 full day on what's safe, 1 full day on stocks and what's hot and how to One other thing I want to let you know, and then I'm going to come back to this real quickly. Did you know that the NASDAQ has almost tripled the returns of the Dow over the last 5 years? So that's something that's actually been pretty consistent for a very, very long time. And it's something that I started pointing out in 2006. There were absolutely fundamental economic reasons why this was looking to be the case. And now we know that it is the case. It's so true that Wall Street is now trying to figure out how to redefine value. And I can see hear Benjamin Graham rolling over in his grave. So this is all stuff that you learn at the retreats. You can read about it in the book. You can learn and implement it at the retreat. So I do recommend that you attend. It's definitely worth its weight in gold. And our online retreats are the most affordable. And you also are going to get, video recordings where you can go back and review them. So the new dates, the 9th through 11th is sold out. The new dates that are available to you are the 23rd through the 25th. Call or email for additional information or to register. Okay, and remember, one last thing is that you can get access to all of these videos at youtube.com/Natalie Pace. In fact, this video is going to be uploaded and it'll be available probably within an hour. So I'm going to go ahead and stop the recording. And we'll have a little bit of a conversation. If you have a quick question, I'll try to do a quick lightning round. All right, so again, thank you so much for joining me. And just as a reminder, please email us at info@nataliepace.com. All of my social media channels are on the homepage at nataliepace.com. I'd love for you to follow us there. I do daily money tips on Twitter and on Instagram. I'm pretty active as well. I try to upload as much as I can to Facebook as well. So be sure that you're following there, because there may be a money tip that you're interested in. And sometimes as well, you can even ask the questions that you're asking here and have a conversation with other investors that might be telling you things, or we might be able to throw a blog or a link in there as well. So social media can be very helpful. Again, the YouTube channel, if you didn't already see, my last interview was with the senior index analyst, Howard Silverblatt. He's of the S&P 500. And we talked about how expensive stocks were. We talked a little bit about the debt ceiling as well. So why not he's been in the industry for 40 years. So why not get a Wall Street insider take, not just mine? All right, I will see you guys in October. Remember, I try to do these on Thursdays at 5 p.m. Pacific. And I believe it's going to be the 2nd Thursday in October. But of course, if you aren't already signed up, email info@nataliepace.com with Videocon in the subject line so we can make sure that you're on our video conference list. Thanks again for joining me, and I look forward to our next meeting, and I look forward to those of you that are coming to our retreat. All right, see you soon.